Hey everybody, I'm Nate Jomaa, Vice President of Strategic Development with Future Home Loans.
And I am Jason Taormina, Senior Director of Mortgage at AutoPayPlus. There's something that's been on my mind a lot lately, right? Has been DTI ratio.
Yeah.
And how a lot of folks, they end up in a higher DTI ratio than they really kind of ever wanted to be, right? I know we've talked about this a little bit, you and I, and a lot of times it's out of their control. It's either they need to live in a certain area or have a certain, bedroom count, bathroom count to fit their family, or maybe it's a school district, maybe they're military and they have to live, close to base, or they just got relocated to where, they didn't really have a say necessarily so much. So they end up at a much higher price point than they ever planned for, which higher price point means higher DTI.
Yeah.
Higher DTI means lower, residual income at the end of every pay period, at the end of every month, right?
Yeah, exactly.
Are you seeing more and more of that these days?
Yeah, definitely. A lot of people, we're getting them approved now, and the margins are just razor thin on what they're able to afford.
Really?
Yeah, more and more we're having to stretch to be able to get somebody into a home, because even with a dual income, they just don't have enough to be able to afford their monthly revolving debt, their monthly installment debt, and the new mortgage.
Right. So not uncommon these days to see 45% and up.
Absolutely
right?
not.
Okay. Is that kind of the new norm?
Unfortunately, I think it might be. It's not a great thing,
right?
But it's what we're seeing.
Okay. And is that, so that right there, right, you and I know, and for those of you guys who don't know, like on conventional loans, really the highest you can even turn the DTI up to on the back end is what, 47, 48?
About 48 is going to be the top of that.
Right.
Beyond that, you're not going to be able to get a automatic approval through the AUS or the automated underwriting systems. You're not going to have it. And there's no manual underwrites on a conventional loan. So if it doesn't pass the DU-LP test, you're not able to go conventional.
That's right. And then, that's just on conventional loan. And now, from an affordability standpoint, you can go higher DTI on some of the government programs, FHA, VA.
Yeah.
But then you're even chipping more into your available income, right? Then you're accounting for, what your available income is month over month. It just keeps getting chewed up. Then that means for those of you guys who don't realize, a 50% DTI on the back end means that 50% of your income every month is already accounted for. It's already gone. So, that money is already spoken for through either installment or revolving debt. You don't get a choice to pull that money back. It's not like you're just trying to put that money away for savings or something that's voluntary or optional.
Right.
It's literally spoken for.
Yeah, and that 50% only represents your housing expense, meaning whatever the cost of your total mortgage is, and anything that's a monthly recurring debt on credit. So beyond that, you're going to have your car insurance,
right? You're
going to have your cell phone, your internet, your food, anything else that's going on. So even at a 50% DTI, that doesn't mean that you still have 50% disposable income.
No, you don't. And it's not, and it's not 50% too. You look at it, right? It's 50% of your total monthly income. Right. But you don't get paid that way. Typically, most folks across the country are getting paid. I think the last number I saw was 82% are getting paid either weekly or biweekly. Is pretty much the new norm.
Yeah.
And so if you look at it, you take 50% of what's left over, like you said, like after not only everything that, is already accounted for in that DTI calculation, but then your groceries, your gas, your gym membership, if your kids have after school activities, the equipment for those kind of things, the field trips, everything that goes into that, that's on top of that.
Yeah. Right? And it gets paid out over the course of the month, maybe in 2 different payments.
Right, exactly. And now we're talking about that, let's use the 50% DTI. We're talking about 50% being left over, but like you said, that's for the whole month.
Right.
You chop that number in half, and now those numbers get really, really small, really, really quick.
You got to make it work somehow.
You do. And like you said, that seems to be kind of the trend that everything is moving towards in the housing market. So
absolutely.
And a lot of folks, it's just out of their control.
Yeah.
You know, so you and I kind of went over some numbers here, you know, going into this and what could be, you know, kind of like a normal type housing scenario for the average consumer, right? So I think we said going in at a $450,000 purchase price at 95% loan to value.
Which means 5% down payment.
5% down payment, right? That leaves us with a loan amount of $427,500, right? So that, and then what interest rate did you use to calculate for our equation here? Do you remember?
I think the base rate that we used for this was 6.5%.
6.5%. Okay, cool. All right. So that gave us a principal and interest of $2,702, right? Now, we always kind of estimate tax and insurance around 1% of the home value, pretty much. We are going to have some PMI on this loan because we're only putting 5% down.
Right.
We don't get to waive that PMI until we're 20% down more or 80% loan to value.
Yep.
So that gave us with a approximate PITI monthly payment of $3,577. Now that is just the mortgage alone, right? Now when we're talking about DTI calculation, we take that number plus we take all of your revolving and installment debt that you have across your different trade lines out there, right? So let's just assume that this person isn't buried in student loans, they're not buried in medical debt, things like that, right? But let's go ahead and assume they have 2 vehicles. Let's assume this is a dual income household scenario. So I don't even think you can get into a car nowadays for really less than $400 a month, right? So assuming they have 2 of those, right? That puts us at, we'll take that $3,577 plus $400 for car 1, another $400 for car 2. That leaves us at $4,377 for that back end 50% debt to income ratio calculation. So if you take that up to 50%, that means your take home is $8,754 every month, right? That can be high for the average consumer.
It can be,
and like you said, like margins are razor thin, so we're kind of seeing that out there.
And something else to consider is when we're looking at this, we're looking at what your gross income is.
Right.
We're not talking about what you're actually bringing home.
That's correct. That's correct. So to Nate's point, right? So if we're talking that number of $8,754 that you have to take home on gross, that's before Uncle Sam gets a cut, right? That's before anything goes to your 401k, health insurance, anything that comes out of there. So now if we're talking about taking that number of, I think we said, what, 4377, that's what you're left over with for the entire month. Okay. Now all the things that we had talked about that you don't get to account for, but again, that's not even your take home, right? And I think what's average, I think tax per period is about like 33-ish% like comes out right off the top, I think. So let's say it's 30% that come right off the top. So that leaves you from the $4,377 to $3,063. Okay, that's for the month. So now the 2 cars we talked about, they obviously need insurance.
Yeah,
I would assume, right? Yeah. So you're probably looking at least $200 a month, if not more for that insurance. So you take $250 off of there, and then you're going to have to put gas in the vehicles, right? So I would say anywhere between $40 and $80 a month. A week rather, for fuel. I use a lot more fuel than that. I travel back and forth from the coast. So, for me, I'm using about $100 a week in fuel. So let's say it's $40 a week for each car. What's the quick math on that? $160 per car per month, right?
Yeah.
$160 per car per month. So now we're down to $24.93. That's before any kind of like groceries,
right,
or anything like that.
You gotta eat.
Gotta eat. So I would say at least a family of 2. If it's in my household, I eat a lot myself.
Sure.
So my grocery bill is probably the biggest bill that I have month over month, I think. What's yours like? $100 a week, $150 a week, easily.
I have a large family, so I don't know that I could really be the standard, the benchmark.
Right.
But let's say it's 150 a week.
A week, okay. So we'll go there. So we'll do 150. Let's see, let's do this instead. All right, so that would be what, 600?
Yeah.
All right, so now we're down to 1893. What else do we have to pay for? So we're fed, got gas in the car, got insurance for the vehicles.
Internet,
right? So internet's $100 a month, I think.
let's say, yeah.
For the slower one.
Yeah.
Water has got to be about $100 a month, I would think.
Yeah. Oh, did we put electricity in there yet?
We didn't. No, we have no electricity yet.
We have no electricity. We have internet, but no electricity.
That's correct. No electricity to run
the internet.
All right, so we're at $1,593.
Cell phone,
right? Cell phone is probably in between $75 and $100 a month, right?
Yeah.
So let's say you got two of them.
Yeah. So let's call it 200.
Another, let's say 150. Right?
Okay,
let's say you got, what's that new consumer cellular?
Yeah.
Right. All right, so that's $1,443, right? And that again is the entire month.
That's right.
That's all you have.
Yeah.
Right. So now you divide that across 2 pay periods.
Yeah, you're looking at a little over $720 per pay period that you have left over.
Yeah. And I mean, and that's dangerous, right? Because not only get away from talking about, just luxury items, right?
Sure.
Like vacations or, clothing or anything like that. Talking about just actual, things that come up. You get in a little fender bender. I think the common deductible on an insurance policy is $500.
Yeah.
Something like that comes up. I mean, you just ate up 33% of your available income, right? Let alone putting away for savings for the holidays, for birthdays, family vacations, anything like that. It just makes it really, really hard to budget when, again, you didn't plan on being in a home that was that high price, but for various reasons, it's what you need. You didn't really have that choice, but it's what worked out best for you and your family, right?
Yeah.
So, that's where I think that our members get the most benefit, right? They use all the tools that are available to them to spread out their mortgage across their monthly payment to make sure that they're staying on budget, staying on track, because when the margins are that thin, you really have to use every tool and everything that is allocated to you, that's available to you, to try and stay on track. Not only to, make sure that you can save, make sure that your family has what they need, but also to protect your financial health.
Right.
I mean, if things, start going, not intentionally, but they start going by the wayside, as well as I do, one of the worst things that can happen on your mortgage or on your credit is a 30-day mortgage late or 60-day, right?
Yeah.
I mean, they will just crush your credit so fast. And I mean, that can prevent you from, let's say rates drop in a year, right? But now you have a mortgage late. What can't you do?
You can't refinance.
You can't refinance.
Very few lenders will allow you to have 1 times 30, which means 1 30-day late within a 12-month period.
Yeah. So, I mean, a lot of folks are counting on that too. A lot of folks are counting on interest rates dropping down. But if by chance you haven't done what you need to do in terms of protecting your mortgage loan, coming up to that, let's say rates drop 2 points, that would drop your monthly payment drastically.
Sure.
Right?
Yeah.
But now you're not available for it.
That's right.
Right. And it wasn't any fault of your own necessarily, but like you said, margins run thin and you didn't necessarily have a choice. It was just kind of the position that you were in. Maybe you got in that fender bender. Yeah. Maybe, God forbid, you had some sort of medical emergency. Things that was totally unforeseen.
That's right. And let's remember, the example that we're using is a $450,000 house. So if your ideal price point is less, that brings this back a little bit. But the reality remains that the mortgage and everything else still eats up a lot of what we're looking at. So you have to find a way to be able to creatively and systematically get where you need to get. And AutoPayPlus provides you with that.
They do. And then, obviously partnering with someone like you, right? You guys are super aggressive on your side with pricing and everything you do at Future Home Loans.
Absolutely.
So, finding a broker like you and like your team is crucial, especially in today's market, because those little eighths and quarters and halves of points matter when it comes to margins being this thing. Because every time that you bring those rates down just even a little bit, that can be the difference of someone's grocery bill, someone's gas bill, someone's emergency fund for, goodness knows what happens.
Exactly. Yeah, exactly.
So, awesome, man. Well, I appreciate you taking the time to crunch numbers. I think that this is the kind of stuff that people don't think about, right? You kind of get the rose-colored glasses on, like during the home buying process. You're super excited. You love the yard. You love the living room, the layout, the 2-car garage, whatever it may be. And then you kind of forget because, they trust you as the trusted, loan officer, right? So you told them you can afford the house, but it's because they can, but then they don't think necessarily, I'm stuck with this, in a great way, but I am stuck with this payment. I'm committed to it. Mm-hmm. And even though you are correct in saying they can afford it, they can afford it, but what does that really look like month over month? And sometimes it looks tight.
Yeah. So if you've listened to this and you're scratching your head saying, how can I take advantage of the ability to be able to spread payments out and to be able to set myself up for a little bit more certainty, reach out to me, reach out to Jason, and we can give you the resources. We can put you in touch with somebody that can talk you through how to get there.
Absolutely. And if, when it comes to home shopping, it's a huge, huge purchase. Don't just trust the first person you talk to. Talk to as many trusted professionals as you possibly can, including Nate and his team over at Future Home Loans. They will get you the best rate. If they can't, they're going to work really, really hard to do what's best for you and your family to get you into your dream home.
It's true. Absolutely. And one thing that most people don't know is that when you have your credit pulled and on a hard inquiry, you can get multiple inquiries from multiple mortgage companies, and it does not impact your score for a small window.
That's right.
So that window is kind of up for negotiation, if you will, but I would say inside of a 2 or 3 week window, if you want to talk to a couple of mortgage people, it would behoove you to try to find who's going to give you the best options.
Right. And that, because they're mortgage folks, right? On your credit inquiry, it all looks the same.
That's right.
It's another mortgage pull. It's another mortgage pull.
That's right.
It's another mortgage pull. If you're running down to like Toyota or Ford or Kane's Furniture or things like that, and you have kind of all over the place, that's a little different. But if you're specifically committed to shopping for a mortgage, then like you said, typically is fine.
Industry specific, correct. And that does not mean go talk to 15 mortgage people. That means talk to 2, maybe 3.
Absolutely. I would agree.
Yeah.
That's about enough. Yeah, for sure. I appreciate talking to you today.
Yeah, appreciate you.
Awesome.
Wow.